the phone to ring. If we call the owner and say, "You own X and we want to buy it," the price will go up. But if the owner calls us and says, "We're stuck with X and we're looking for an exit," the price will go down. Thus, rather than initiating transactions, we prefer to react opportunistically. At any particular point in time, the investment environment is a given, and we have no alternative other than to accept it and invest within it. There isn't always a pendulum or cycle extreme to bet against. Sometimes greed and fear, optimism and pessimism, and credulousness and skepticism are balanced, and thus clear mistakes aren't being made. Rather than obviously overpriced or underpriced, most things may seem roughly fairly priced. In that case, there may not be great bargains to buy or compelling sales to make. It's essential for investment success that we recognize the condition of the market and decide on our actions accordingly. The other possibilities are A. Acting without recognizing the market status, B. Acting with indifference to its status, and C. Believing we can somehow change its status. These are most unwise. It makes perfect sense that we must invest appropriately for the circumstances with which we're presented. In fact, nothing else makes sense at all. I come to this from a philosophic foundation. In the mid-60s, Wharton students had to have a non-business minor, and I satisfied the requirement by taking 5 courses in Japanese studies. These surprised me by becoming the highlight of my college career, and later they contributed to my investment philosophy in a major way. Among the values prized in early Japanese culture was mujo. Mujo was defined classically for me as recognition of the turning of the wheel of the law, implying acceptance of the inevitability of change, of rise and fall. In other words, mujo means cycles will rise and fall, things will come and go, and our environment will change in ways beyond our control. Thus we must recognize, accept, cope and respond. Isn't that the essence of investing? What's past is past and can't be undone. It has led to the circumstances we now face. All we can do is recognize our circumstances for what they are and make the best decisions we can, given the givens. It is what it is. March 27, 2006. Warren Buffett's philosophy is a little less spiritually based than mine. Instead of mujo, his reference is to baseball. In Berkshire Hathaway's 1997 annual report, Buffett talked about Ted Williams, the splendid splinter, one of the greatest hitters in history. A factor that contributed to his success was his intensive study of his own game. By breaking down the strike zone into 77 baseball-sized cells and charting his results at the plate, he learned that his batting average was much better when he went after only pitches in his sweet spot. Of course, even with that knowledge, he couldn't wait all day for the perfect pitch. If he let 3 strikes go by without swinging, he'd be called out. Way back in the November 1, 1974, issue of Forbes, Buffett pointed out that investors have an advantage in that regard, if they'll just seize it. Because they can't strike out looking, investors needn't feel pressure to act. They can pass up lots of opportunities until they see one that's terrific. Investing is the greatest business in the world because you never have to swing. You stand at the plate, the pitcher throws you General Motors at 47. US Steel at 39. And nobody calls a strike on you. There's no penalty except opportunity. All day you wait for the pitch you like, then, when the 5 elders are asleep, you step up and hit it. What's your game plan? September 5, 2003. One of the great things about investing is that the only real penalty is for making losing investments. There's no penalty for omitting losing investments, of course, just rewards. And even for missing a few winners, the penalty is bearable. Where does the penalty for missing winners come in? Well, investors are generally competitive and in it for the money. Thus, no one's totally comfortable with missing a profitable opportunity. For professional investors paid to manage others' money, the stakes are higher. If they miss too many opportunities, and if their returns are too low in good times, money managers can come under pressure from clients and eventually lose accounts. A lot depends on how clients have been conditioned. Oaktree has always been explicit about our belief that missing a profitable opportunity is of less significance than investing in a loser. Our clients are prepared for results that put risk control ahead of full participation in gains. Standing at the plate with the bat on your shoulders is Buffett's version of patient opportunism. The bat should come off our shoulders. When there are opportunities for profit with controlled risk, but only then. One way to be selective in this regard is by making every effort to ascertain whether we're in a low-return environment or a high-return environment. A few years ago I came up with an allegory applicable to low-return environments. It was called the cat, the tree, the carrot and the stick. The cat is an investor, whose job it is to cope with the investment environment, of which the tree is part. The carrot, the incentive to accept increased risk, comes from the higher returns seemingly available from riskier investments. And the stick, the motivation to forsake safety, comes from the modest level of the prospective returns being offered on safer investments. The carrot lures the cat to higher branches, riskier strategies, in pursuit of its dinner, its targeted return, and the stick prods the cat up the tree, because it can't get dinner while staying close to the ground. Together, the stick and the carrot can cause the cat to climb until it ultimately arrives high up in the tree, in a treacherous position. The critical observation is that the cat pursues high returns, even in a low-return environment, and bears the consequences, increased risk, although often unknowingly. Bond investors call this process reaching for yield or reaching for return. It has classically consisted of investing in riskier credits as the yields on safer ones decline, in order to access the returns to which investors were accustomed before the market rose. That same pattern of taking new and bigger risks in order to perpetuate return often repeats in a cyclical pattern. The motto of those who reach for return seems to be, if you can't get the return you need from safe investments, pursue it via risky investments. We saw this behavior playing out in the middle of the past decade. In the days before the credit crisis, investors succumbed to the siren song of leverage. They borrowed cheap short-term funds. The shorter the cheaper, you can get money cheap if you're willing to promise repayment monthly. And they used that money to buy assets that offered higher returns because they entailed illiquidity and/or fundamental risk. And institutional investors all over the world took Wall Street up on the newest promises of 2 silver bullets that would provide high returns. With low risk, securitization and structure. On the surface, these investments made sense. They promised satisfactory absolute returns, as the returns on the levered purchases would more than pay the cost of capital. The results would be great, as long as nothing untoward happened. But, as usual, the pursuit of profit led to mistakes. The expected returns looked good, but the range of possible outcomes included some very nasty ones. The success of many techniques and structures depended on the future looking like the past. And many of the modern miracles that were relied on were untested. No different this time, December 17, 2007. It's remarkable how many leading competitors from our early years as investors are no longer leading competitors, or competitors at all. While a number faltered because of flaws in their or GANIZA tie-in or business model, others disappeared because they insisted on pursuing high returns in low-return environments. You simply cannot create investment opportunities when they're not there. The dumbest thing you can do is to insist on perpetuating high returns, and give back your profits in the process. If it's not there, hoping won't make it so. When prices are high, it's inescapable that prospective returns are low, and risks are high. That single sentence provides a great deal of guidance as to appropriate portfolio actions. How are we to factor such an observation into our practices? In 2004 I wrote a memo titled Risk and Return Today. In it, as described in Chapter 6, I expressed my view that, a. the capital market line then was low and flat, meaning prospective returns in almost all markets were among the lowest we'd ever seen and risk premiums were the narrowest, and, b. if prospective returns should rise, it'd likely happen through price declines. But the hard question is, what can we do about it? A few weeks later, I suggested a few possibilities. How might one cope in a market that seems to be offering low returns? Invest as if it's not true. The trouble with this is that wishing won't make it so. Simply put, it doesn't make sense to expect traditional returns when elevated asset prices suggest they're not available. I was pleased to get a letter from Peter Bernstein in response to my memo, in which he said something wonderful. The market's not a very accommodating machine, it won't provide high returns just because you need them. Invest anyway, trying for acceptable relative returns under the circumstances, even if they're not attractive in the absolute. Invest anyway, ignoring short-run risk and focusing on the long run. This isn't irrational, especially if you accept the notion that market timing and tactical asset allocation are difficult. But before taking this path, I'd suggest that you get a commitment from your investment committee or other constituents that they'll ignore short-term losses. Hold cash, but that's tough for people who need to meet an actuarial assumption or spending rate, who want their money to be fully employed at all times, or who'll be uncomfortable, or lose their jobs, if they have to watch for long as others make money they don't. Concentrate your investments in special niches and special people, as I've been droning on about for the last couple of years. But that gets harder as the size of your portfolio grows. And identifying managers with truly superior talent, discipline and staying power certainly isn't easy. The truth is, there's no easy answer for investors faced with skimpy prospective returns and risk premiums. But there is one course of action, one classic mistake, that I most strongly feel is wrong: reaching for return. Given today's paucity of prospective return at the low-risk end of the spectrum and the solutions being ballyhooed at the high-risk end, many investors are moving capital to riskier, or at least less traditional, investments. But, A, they're making those riskier investments just when the prospective returns on those investments are the lowest they've ever been. B, they're accepting return increments for stepping up in risk that are as slim as they've ever been. And, C, they're signing up today for things they turned down, or did less of, in the past, when the prospective returns were much higher. This may be exactly the wrong time to add to risk in pursuit of more return. You want to take risk when others are fleeing from it, not when they're competing with you to do so. There they go again, May 6, 2005. It's clear that this was written too early. May 2005 wasn't the perfect time to get off the merry-go-round, May 2007 was. Being early provided a good reminder about the pain involved in being too far ahead of your time. Having said that, it was much better to get off too soon in May 2005 than to stay on past May 2007. I've tried to make clear that the investment environment greatly influences outcomes. To wring high returns from a low-return environment requires the ability to swim against the tide and find the relatively few winners. This must be based on some combination of exceptional skill, high risk-bearing and good luck. High-return environments, on the other hand, offer opportunities for generous returns through purchases at low prices, and typically these can be earned with low risk. In the crises of 1990, 2002 and 2008, for example, not only did our funds earn unusually high returns, but we feel they did it through investments where loss was unlikely. The absolute best buying opportunities come when asset holders are forced to sell, and in those crises they were present in large numbers. From time to time, holders become forced sellers for reasons like these: the funds they manage experience withdrawals. Their portfolio holdings violate investment guidelines such as minimum credit ratings or position maximums. They receive margin calls because the value of their assets fails to satisfy requirements agreed to in contracts with their lenders. As I've said many times, the real goal of active investment management is to buy things for less than they're worth. This is what the efficient market hypothesis says we can't do. The theory's objection seems reasonable: why should someone part with something at a bargain? Price, especially if the potential seller is informed and rational, usually would be sellers. Balance the desire to get a good price with the desire to get the trade done soon. The beauty of forced sellers is that they have no choice. They have a gun at their heads and have to sell regardless of price. Those last three words, regardless of price, are the most beautiful in the world if you're on the other side of the transaction. If a single holder is forced to sell, dozens of buyers will be there to accommodate, so the trade may take place at a price that is only slightly reduced. But if chaos is widespread, many people will be forced to sell at the same time and few people will be in a position to provide the required liquidity. The difficulties that mandate selling, plummeting prices, withdrawal of credit, fear among counterparties or clients, have the same impact on most investors. In that case, prices can fall far below intrinsic value. The fourth quarter of 2008 provided an excellent example of the need for liquidity in times of chaos. Let's focus on leveraged investment entities' holdings of senior bank loans. Because these loans were highly rated and credit was freely available during the years leading up to the crisis, it was easy to borrow large sums with which to lever debt portfolios, magnifying the potential returns. A typical investor on margin might have agreed to post additional capital if the price of the collateral fell below 85 cents on the dollar. Secure in the knowledge that in the past, loans like these had never traded much below par, or 100 cents on the dollar. When the credit crisis hit, everything went wrong for leveraged investors in bank loans. And because the yields on these supposedly safe loans had been so low, almost all of the buyers had used leverage to enhance their expected returns. Loan prices fell. Liquidity dried up. Since much of the buying had been done with borrowed funds, the credit market contraction affected large numbers of holders. As the number of would-be sellers exploded, buyers for cash disappeared. And with additional credit unavailable, no new levered buyers could step forward to absorb the selling. Prices fell to 95, and then 90, and then 85. And as each portfolio reached its trigger, the bank issued a margin call, or a demand for a capital infusion. Few investors had the resources and nerve required to add capital in that environment, so the banks took over the portfolios and liquidated them. BWIC, pronounced BWIC, came into common use, an acronym for bid. Wanted in competition. Investors were informed of a BWIC in the afternoon and told bids were wanted for an auction to be held the next morning. The few possible buyers bid low, hoping to get real bargains. No one needed to worry about bidding too low, since there was sure to be another BWIC behind this one. And the banks weren't concerned with getting fair prices, all they needed was enough proceeds to cover their loans, perhaps 75 or 80 cents on the dollar. Any excess would go to the investor, but the banks didn't care about generating anything for them. Thus BWICs took place at incredibly low prices. Loan prices eventually fell into the 60s, and every holder on short-term credit who couldn't access additional capital was likely wiped out. Selling prices were ridiculous. The declines on senior loan indices in 2008 exceeded those on subordinated high-yield bond indices, certainly signaling an inefficiency. You could buy first lien debt at prices from which you would break even if the issuing company turned out to be worth 20 to 40% of what a buyout fund had paid for it just a year or two earlier. The promised yields were very large, and in fact much of this paper appreciated dramatically in 2009. This was a time for the patient opportunist to step forward. It was primarily those who had been cognizant of the risks in 2006 and 2007 and kept their powder dry, waiting for opportunity, who were able to do so. The key during a crisis is to be A. Insulated from the forces that require selling and B. Positioned to be a buyer instead. To satisfy those criteria, an investor needs the following things: staunch reliance on value, little or no use of leverage, long-term capital and a strong stomach. Patient opportunism, buttressed by a contrarian attitude and a strong balance sheet, can yield amazing profits during meltdowns. Chapter 14. The most important thing is knowing what you don't know. We have two classes of forecasters, those who don't know, and those who don't know they don't know. John Kenneth Galbraith. It's frightening to think that you might not know something, but more frightening to think that, by and large, the world is run by people who have faith that they know exactly what's going on. Amos Tversky. There are two kinds of people who lose money, those who know nothing and those who know everything. Henry Kaufman. I've chosen 3 quotes with which to lead off this chapter, and I have a million more where those came from. Awareness of the limited extent of our foreknowledge is an essential component of my approach to investing. I'm firmly convinced that, A. It's hard to know what the macro future holds and, B. Few people possess superior knowledge of these matters that can regularly be turned into an investing advantage. There are 2 caveats, however. The more we concentrate on smaller, picture things, the more it's possible to gain a knowledge advantage. With hard work and skill, we can consistently know more than the next person about individual companies and securities, but that's much less likely with regard to markets and economies. Thus, I suggest people try to know the knowable. An exception comes in the form of my suggestion, on which I elaborate in the next chapter, that investors should make an effort to figure out where they stand at a moment in time in terms of cycles and pendulums. That won't render the future twists and turns knowable, but it can help one prepare for likely developments. I am not going to try to prove my contention that the future is unknowable. You can't prove a negative, and that certainly includes this one. However, I have yet to meet anyone who consistently knows what lies ahead macro-wise. Of all the economists and strategists you follow, are any correct most of the time? My research on this subject, and I use quotation marks because my efforts in the area are too limited and anecdotal to be considered serious research, has consisted primarily of reading forecasts and observing their lack of utility. I wrote 2 memos as a result: The Value of Predictions, or Where'd All This Rain Come From? February 15, 1993, and The Value of Predictions 2, or Give That Man a Cigar, August 22, 1996. In the second memo, I used data from 3 semi-annual Wall Street Journal economic polls to examine the usefulness of forecasts. First, were the forecasts generally accurate? The answer was clearly no. On average, the predictions for the 90-day T-bill rate, 30-year bond rate and yen/dollar exchange rate 6 and 12 months out were off by 15%. The average forecaster missed the interest rate on the long bond 6 months later by 96 basis points, a divergence big enough to change the value of a $1,000 bond by $120. Second, were the forecasts valuable? Predictions are most useful when they correctly anticipate change. If you predict that something won't change and it doesn't change, that prediction is unlikely to earn you much money. But accurately predicting change can be very profitable. In the journal polls, I observed, the forecasters completely missed several major changes. When accurate forecasts would have helped people make money or avoid a loss: the interest rate increases of 1994 and 1996, the rate decline of 1995, and the massive gyrations of the dollar/yen relationship. In summary, there simply wasn't much correlation between predicted changes and actual changes. Third, what was the source of the forecasts? The answer here is simple: most of the forecasts consisted of extrapolations. On average, the predictions were within 5% of the levels that prevailed at the time they were made. Like many forecasters, these economists were driving with their eyes firmly fixed on the rearview mirror. enabling them to tell us where things were but not where they were going. This bears out the old adage that it's difficult to make accurate predictions, especially with regard to the future. The corollary is also true: predicting the past is a snap. Fourth, were the forecasters ever right? The answer is a firm yes. For example, in each semi-annual forecast, someone nailed the yield on the 30-year bond within 10 or 20 basis points, even as interest rates changed radically. The winning forecast was much more accurate than the consensus forecast, which was off by 70 to 130 basis points. Fifth, if the forecasters were sometimes right, and right so dramatically, then why do I remain so negative on forecasts? Because the important thing in forecasting isn't getting it right once. The important thing is getting it right consistently. I went on in the 1996 memo to show 2 things that might make you think twice about heeding the winner's forecasts. First, they generally fail to make accurate predictions in surveys other than the one they won. And second, half the time in the surveys they didn't win, their forecasts were much more wrong than even the inaccurate consensus. The most important thing, of course, isn't the data, but the conclusions, assuming they're correct and capable of being generalized, and their ramifications. One way to get to be right sometimes is to always be bullish or always be bearish. If you hold a fixed view long enough, you may be right sooner or later. And if you're always an outlier, you're likely to eventually be applauded for an extremely unconventional forecast that correctly foresaw what no one else did. But that doesn't mean your forecasts are regularly of any value. It's possible to be right about the macro future once in a while, but not on a regular basis. It doesn't do any good to possess a survey of 60 for forecasts that includes a few that are accurate. You have to know which ones they are. And if the accurate forecasts each 6 months are made by different economists, it's hard to believe there's much value in the collective forecasts. The value of predictions too, or give that man a cigar, August 22, 1996 is discussion of. Forecast suggests that we have a dilemma. Investment results will be determined entirely by what happens in the future, and while we may know what will happen much of the time, when things are normal, we can't know much about what will happen at those moments when knowing would make the biggest difference. Most of the time, people predict a future that is a lot like the recent past. They're not necessarily wrong. Most of the time the future largely is a rerun of the recent past. On the basis of these 2 points, it's possible to conclude that forecasts will prove accurate much of the time. They'll usually extrapolate recent experience and be right. However, the many forecasts that correctly extrapolate past experience are of little value. Just as forecasters usually assume a future that's a lot like the past, so do markets, which usually price in a continuation of recent history. Thus, if the future turns out to be like the past, it's unlikely big money will be made, even by those who foresaw correctly that it would. Once in a while, however, the future turns out to be very different from the past. It's at these times that accurate forecasts would be of great value. It's also at these times that forecasts are least likely to be correct. Some forecasters may turn out to be correct at these pivotal moments, suggesting that it's possible to correctly forecast key events, but it's unlikely to be the same people consistently. The sum of this discussion suggests that, on balance, forecasts are of very little value. If you need proof, ask yourself how many forecasters correctly predicted the subprime problem, global credit crisis and massive meltdown of 2007 to 2008. You might be able to think of a few, and you might conclude that their forecasts were valuable. But then ask yourself how many of those few went on to correctly foresee the economic recovery that started slowly in 2009 and the massive market rebound that year. I think the answer's very few. And that's not an accident. Those who got 2007 to 2008 right probably did so at least in part because of a tendency toward negative views. As such, they probably stayed negative for 2009. The overall usefulness of those forecasts wasn't great, even though they were partially right about some of the most momentous financial events in the last 80 years. So the key question isn't, are forecasters sometimes right, but rather, are forecasts as a whole, or any one person's forecasts, consistently actionable and valuable? No one should bet much on the answer being affirmative. A prediction of global crisis in 2007 to 2008 would have had great potential value. But if you saw that it came from someone who wasn't right consistently, and someone with a visible negative bias, would you have acted? That's the trouble with inconsistent forecasters, not that they're never right, but that the record isn't positive enough to inspire action on their occasional brainstorms. It's no secret that I have a limited opinion of forecasters and those who resolutely believe in them. In fact, I've come up with a label for these people. Most of the investors I've met over the years have belonged to the I know school. It's easy to identify them. They think knowledge of the future direction of economies, interest rates, markets, and widely followed mainstream stocks is essential for investment success. They're confident it can be achieved. They know they can do it. They're aware that lots of other people are trying to do it too, but they figure either A, everyone can be successful at the same time, or B, only a few can be, but they're among them. They're comfortable investing based on their opinions regarding the future. They're also glad to share their views with others, even though correct forecasts should be of such great value that no one would give them away gratis. They rarely look back to rigorously assess their record as forecasters. Confident is the key word for describing members of this school. For the I don't know school, on the other hand, the word, especially when dealing with the macro future, is guarded. Its adherents generally believe you can't know the future, you don't have to know the future, and the proper goal is to do the best possible job of investing in the absence of that knowledge. As a member of the I know school, you get to opine on the future, and maybe have people take notes. You may be sought out for your opinions and considered a desirable dinner guest, especially when the stock market's going up. Join the I don't know school and the results are more mixed. You'll soon tire of saying, I don't know, to friends and strangers alike. After a while, even relatives will stop asking where you think the market's going. You'll never get to enjoy that 1-in-a-thousand moment when your forecast comes true and the Wall Street Journal runs your picture. On the other hand, you'll be spared all those times when forecasts miss the mark, as well as the losses that can result from investing based on overrated knowledge of the future. Us and them, May 7, 2004. No one likes having to invest for the future under the assumption that the future is largely unknowable. On the other hand, if it is, we'd better face up to it and find other ways to cope than through forecasts. Whatever limitations are imposed on us in the investment world, it's a heck of a lot better to acknowledge them and accommodate than to deny them and forge ahead. Oh yes, one other thing, the biggest problems tend to arise when investors forget about the difference between probability and outcome, that is, when they forget about the limits on foreknowledge, when they believe the shape of the probability distribution is knowable with certainty, and that they know it, when they assume the most likely outcome is the one that will happen, when they assume the expected result accurately represents the actual result, or perhaps most important, when they ignore the possibility of improbable outcomes. Imprudent investors who overlook these limitations tend to make mistakes in their portfolios and experience occasional large losses. That was the story of 2004 to 2007, because many people overestimated the extent to which outcomes were knowable and controllable. They underestimated the risk present in the things they were doing. The question of whether trying to predict the future will or will not work isn't a matter of idle curiosity or academic musing. It has, or should have, significant ramifications for investor behavior. If you're engaged in an activity that involves decisions with consequences in the future, it seems patently obvious that you'll act one way if you think the future can be foreseen and a very different way if you think it can't. One key question investors have to answer is whether they view the future as knowable or unknowable. Investors who feel they know what the future holds will act assertively, making directional bets, concentrating positions, levering holdings and counting on future growth, in other words, doing things that in the absence of foreknowledge would increase risk. On the other hand, those who feel they don't know what the future holds will act quite differently, diversifying, hedging, levering less, or not at all, emphasizing value today over growth tomorrow, staying high in the capital structure, and generally girding for a variety of possible outcomes. The first group of investors did much better in the years leading up to the crash. But the second group was better prepared and the crash unfolded, and they had more capital available, and more intact psyches, with which to profit from purchases made at its nadir. Touchstones. November 10, 2009. If you know the future, it's silly to play defense. You should behave aggressively and target the greatest winners. There can be no loss to fear. Diversification is unnecessary, and maximum leverage can be employed. In fact, being unduly modest about what you know can result in opportunity costs, foregone profits. On the other hand, if you don't know what the future holds, it's foolhardy to act as if you do. Harkening back to Amos Tversky in the powerful quote that opened this chapter, the bottom line is clear. Investing in an unknowable future as an agnostic is a daunting prospect, but if foreknowledge is elusive, investing as if you know what's coming is close to nuts. Maybe Mark Twain put it best, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Overestimating what you're capable of knowing or doing can be extremely dangerous. In brain surgery, transocean racing or investing. Acknowledging the boundaries of what you can know, and working within those limits rather than venturing beyond, can give you a great advantage. Chapter 15. The most important thing is having a sense for where we stand. We may never know where we're going, but we'd better have a good idea where we are. Market cycles present the investor with a daunting challenge, given that their ups and downs are inevitable. They will profoundly influence our performance as investors. They are unpredictable as to extent and, especially, timing. So we have to cope with a force that will have great impact but is largely unknowable. What, then, are we to do about cycles? The question is of vital importance, but the obvious answers, as so often, are not the right ones. The first possibility is that rather than accept that cycles are unpredictable, we should redouble our efforts to predict the future, throwing added resources into the battle and betting increasingly on our conclusions. But a great deal of data, and all my experience, tell me that the only thing we can predict about cycles is their inevitability. Further, superior results in investing come from knowing more than others, and it hasn't been demonstrated to my satisfaction that a lot of people know more than the consensus about the timing and extent of future cycles. The second possibility is to accept that the future isn't knowable, throw up our hands, and simply ignore cycles. Instead of trying to predict them, we could try to make good investments and hold them throughout. Since we can't know when to hold more or less of them, or when our investment posture should become more aggressive or more defensive, we could simply invest with total disregard for cycles and their profound effect. This is the so-called buy and hold approach. There's a third possibility, however, and in my opinion it's the right one by a wide margin. Why not simply try to figure out where we stand in terms of each cycle and what that implies for our actions? In the world of investing, nothing is as dependable as cycles. Fundamentals, psychology, prices and returns will rise and fall, presenting opportunities to make mistakes or to profit from the mistakes of others. They are the givens. We cannot know how far a trend will go, when it will turn, what will make it turn, or how far things will then go in the opposite direction. But I'm confident that every trend will stop sooner or later. Nothing goes on forever. So what can we do about cycles? If we can't know in advance how and when the turns will occur, how can we cope? On this, I am dogmatic. We may never know where we're going, but we'd better have a good idea where we are. That is, even if we can't predict the timing and extent of cyclical fluctuations, it's essential that we strive to ascertain where we stand in cyclical terms and act accordingly. It is what it is. March 27, 2006. It would be wonderful to be able to successfully predict the swings of the pendulum and always move in the appropriate direction, but this is certainly an unrealistic expectation. I consider it far more reasonable to try to A. Stay alert for occasions when a market has reached an extreme, B. Adjust our behavior in response, and C. Most important, refuse to fall into line with the herd behavior that renders so many investors dead wrong at tops and bottoms. First quarter performance, April 11, 1991. I don't mean to suggest that if we can figure out where we stand in a cycle we'll know precisely what's coming next. But I do think that understanding will give us valuable insight into future events and what we might do about them, and that's all we can hope for. When I say that our present position, unlike the future, is knowable, I don't mean to imply that understanding comes automatically. Like most things about investing, it takes work. But it can be done. Here are a few concepts I consider essential in that effort. First, we must be alert to what's going on. The philosopher Santayana said, "Those who cannot remember the past are condemned to repeat it." In very much the same way, I believe those who are unaware of what's going on around them are destined to be buffeted by it. As difficult as it is to know the future, it's really not that hard to understand the present. What we need to do is take the market's temperature. If we are alert and perceptive, we can gauge the behavior of those around us and from that judge what we should do. The essential ingredient here is inference, one of my favorite words. Everyone sees what happens each day, as reported in the media. But how many people make an effort to understand what those everyday events say about the psyches of market participants, the investment climate, and thus what we should do in response? Simply put, we must strive to understand the implications of what's going on around us. When others are recklessly confident and buying aggressively, we should be highly cautious. When others are frightened into inaction or panic selling, we should become aggressive. So look around and ask yourself, are investors optimistic or pessimistic? Do the media talking heads say the markets should be piled into or avoided? Are novel investment schemes readily accepted or dismissed out of hand? Are securities offerings and fund openings being treated as opportunities to get rich or possible pitfalls? Has the credit cycle rendered capital readily available or impossible to obtain? Are price/earnings ratios high or low in the context of history, and are yield spreads tight or generous? All of these things are important, and yet none of them entails forecasting. We can make excellent investment decisions on the basis of present observations, with no need to make guesses about the future. The key is to take note of things like these and let them tell you what to do. While the markets don't cry out for action along these lines every day, they do at the extremes, when their pronouncements are highly important. The years 2007 to 2008 can be viewed as a painful time for markets and their participants, or as the greatest learning experience in our lifetimes. They were both, of course, but dwelling on the former isn't of much help. Understanding the latter can make anyone a better investor. I can think of no better example than the devastating credit crisis to illustrate the importance of making accurate observations regarding the present and the folly of trying to forecast the future. It warrants a detailed discussion. It's obvious in retrospect that the period leading up to the onset of the financial crisis in mid-2007 was one of unbridled, and unconscious, risk-taking. With attitudes cool towards stocks and bonds, money flowed to alternative investments such as private equity, buyouts, in amounts sufficient to doom them to failure. There was unquestioning acceptance of the proposition that homes and other real estate would provide sure profits and cushion against inflation. And 2. Free access to capital with low interest rates and loose terms encouraged the use of leverage in amounts that proved excessive. After the fact, risk awareness doesn't do much good. The question is whether alertness and inference would have helped one avoid the full brunt of the 2007 to 2008 market declines. Here are some of the indicators of heatedness we saw. The issuance of high-yield bonds and below investment-grade leveraged loans was at levels that constituted records by wide margins. An unusually high percentage of the high-yield bond issuance was rated CCC, a quality level at which new bonds usually can't be sold in large amounts. Issuance of debt to raise money for dividends to owners was routine. In normal times, such transactions, which increase the issuer's riskiness and do nothing for creditors, are harder to accomplish. Debt was increasingly issued with coupons that could be paid with more debt, and with few or no covenants to protect creditors. Formerly rare AAA debt ratings were assigned by the thousands to tranches of untested structured vehicles. Buyouts were done at increasing multiples of cash flow and at increasing leverage ratios. On average, buyout firms paid 50% more for $1 of cash flow in 2007 than they had in 2001. There were buyouts of firms in highly cyclical industries such as semiconductor manufacturing. In more skeptical times, investors take a dim view of combining leverage and cyclicality. Taking all these things into consideration, a clear inference was possible that providers of capital were competing to do so, easing terms and interest rates rather than demanding adequate protection and potential rewards. The 7 scariest words in the world for the thoughtful investor, too much money chasing too few deals, provided an unusually apt description of market conditions. You can tell when too much money is competing to be deployed. The number of deals being done increases, as does the ease of doing deals, the cost of capital declines, and the price for the asset being bought rises with each successive transaction. A torrent of capital is what makes it all happen. If you make cars and want to sell more of them over the long term, that is, take permanent market share from your competitors, you'll try to make your product better. That's why, one way or the other, most sales pitches say, ours is better. However, there are products that can't be differentiated, and economists call them commodities. Goods where no seller's offering is much different from any other. They tend to trade on price alone, and each buyer is likely to take the offering at the lowest delivered price. Thus, if you deal in a commodity and want to sell more of it, there's generally one way to do so: cut your price. It helps to think of money as a commodity just like those others. Everyone's money is pretty much the same. Yet institutions seeking to add to loan volume, and private equity funds and hedge funds seeking to increase their fees, all want to move more of it. So if you want to place more money, that is, get people to go to you instead of your competitors for their financing, you have to make your money cheaper. One way to lower the price for your money is by reducing the interest rate you charge on loans. A slightly more subtle way is to agree to a higher price for the thing you're buying, such as by paying a higher price/earnings ratio for a common stock or a higher total transaction price when you're buying a company. Any way you slice it, you're settling for a lower prospective return. The race to the bottom, February 17, 2007. One trend investors might have observed during this dangerous period, had they been alert, was the movement along the spectrum that runs from skepticism to credulousness in regard to what I described earlier as the silver bullet or can't-lose investment. Thoughtful investors might have noticed that the appetite for silver bullets was running high, meaning greed had won out over fear and signifying a non-skeptical, and thus risky, market. Hedge funds came to be viewed as just such a sure thing during the last decade, and especially those called absolute return funds. These were long/short or arbitrage funds that wouldn't pursue high returns by making directional bets on the market's trend. Rather, the manager's skill or technology would enable them to produce consistent returns in the range of 8 to 11% regardless of which way the market went. Too few people recognize that achieving rock-steady returns in that range would be a phenomenal accomplishment, perhaps too good to be true. NB, that's exactly what Bernard Madoff purported to be earning. Too few wondered, A, how many managers there are with enough talent to produce that miracle, especially after the deduction of substantial management and incentive fees, B, how much money they could do it with, and C, how their highly levered bets on small statistical discrepancies would fare in a hostile environment. In the difficult year of 2008, the term absolute return was shown to have been overused and misused, as the average fund lost about 18%. As described at length in Chapter 6, we heard at the time that risk had been eliminated through the newly popular wonders of securitization, tranching, selling onward, disintermediation and decoupling. Tranching deserves particular attention here. It consists of allocating a portfolio's value and cash flow to stakeholders in various tiers of seniority. The owners of the top tier claim get paid first, thus, they enjoy the greatest safety and settle for relatively low returns. Those with bottom-tier claims are in the first loss position, and in exchange for accepting heightened risk they enjoy the potential for high returns from the residual that's left over after the fixed claims of the senior tranches have been paid off. In the years 2004 to 2007, the notion arose that if you cut risk into small pieces and sell the pieces off to investors best suited to hold them, the risk disappears. Sounds like magic. Thus, it's no coincidence that the tranched securitizations from which so much was expected became the site of many of the worst meltdowns. There's simply no magic in investing. Absolute return funds, low-cost leverage, riskless real estate investments and tranched debt vehicles were all the rage. Of course, the error in all these things became clear beginning in August 2007. It turned out that risk hadn't been banished and, in fact, had been elevated by investors' excessive trust and insufficient skepticism. The period from 2004 through the middle of 2007 presented investors with one of the greatest opportunities to outperform by reducing their risk, if only they were perceptive enough to recognize what was going on and confident enough to act. All you really had to do was take the market's temperature during an overheated period and deplane as it continued upward. Those who were able to do so exemplify the principles of contrarianism, discussed in Chapter 11. Contrarian investors who had cut their risk and otherwise prepared during the lead up to the crisis lost less in the 2008 meltdown and were best positioned to take advantage of the vast bargains it created. There are few fields in which decisions as to strategies and tactics aren't influenced by what we see in the environment. Our pressure on the gas pedal varies depending on whether the road is empty or crowded. The golfer's choice of club depends on the wind. Our decision regarding outerwear certainly varies with the weather. Shouldn't our investment actions be equally affected by the investing climate? Most people strive to adjust their portfolios based on what they think lies ahead. At the same time, however, most people would admit forward visibility just isn't that great. That's why I make the case for responding to the current realities and their implications, as opposed to expecting the future to be made clear. It is what it is. March 27, 2006. Markets move cyclically, rising and falling. The pendulum oscillates, rarely pausing at the happy medium, the midpoint of its arc. Is this a source of danger or of opportunity? And what are investors to do about it? My response is simple: try to figure out what's going on around us, and use that to guide our actions. Chapter 16. The most important thing is appreciating the role of luck. Every once in a while, someone makes a risky bet on an improbable or uncertain outcome and ends up looking like a genius. But we should recognize that it happened because of luck and boldness, not skill. The investment world is not an orderly and logical place where the future can be predicted and specific actions always produce specific results. The truth is, much in investing is ruled by luck. Some may prefer to call it chance or randomness, and those words do sound more sophisticated than luck. But it comes down to the same thing. A great deal of the success of everything we do as investors will be heavily influenced by the roll of the dice. To fully explore the notion of luck, in this chapter one want to advance some ideas expressed by Nassim Nicholas Taleb in his book Fooled by Randomness. Some of the concepts I explore here occurred to me before I read it, but Taleb's book put it all together for me and added more. I consider it one of the most important books an investor can read. I borrowed some of Taleb's ideas for a 2002 memo titled Returns and How They Get That Way, which incorporated excerpts from Fooled by Randomness, represented here by italics. Randomness, or luck, plays a huge part in life's results and outcomes that hinge on random events should be viewed as different from those that do not. Thus, when considering whether an investment record is likely to be repeated, it is essential to think about the role of randomness in the manager's results, and whether the performance resulted from skill or simply being lucky. $10 million earned through Russian roulette does not have the same value as $10 million earned through the diligent and artful practice of dentistry. They are the same, can buy the same goods, except that one's dependence on randomness is greater than the other. To your accountant, though, they would be identical. Yet, deep down, I cannot help but consider them as qualitatively different. Every record should be considered in light of the other outcomes. Taleb calls them alternative histories, that could have occurred just as easily as the visible histories that did. Clearly, my way of judging matters is probabilistic in nature. It relies on the notion of what could have probably happened. If we have heard of history's great generals and inventors, it is simply because they took considerable risks, along with thousands of others, and happened to win. They were intelligent, courageous, noble, at times, had the highest possible obtainable culture in their day, but so did thousands of others who live in the musty footnotes of history. Every once in a while, someone makes a risky bet on an improbable or uncertain outcome and ends up looking like a genius. But we should recognize that it happened because of luck and boldness, not skill. Think about the aggressive backgammon player who can't win without a roll of double sixes, with its probability of happening once in every 36 rolls of the dice. The player accepts the cube, doubling the stakes, and then gets his boxcars. It might have been an unwise bet, but because it succeeded, everybody considers the player brilliant. We should think about how probable it was that something other than double sixes would materialize, and thus how lucky the player was to have won. This says a lot about the player's likelihood of winning again. In the short run, a great deal of investment success can result from just being in the right place at the right time. I always say the keys to profit are aggressiveness, timing and skill, and someone who has enough aggressiveness at the right time doesn't need much skill. At a given time in the markets, the most profitable traders are likely to be those that are best fit to the latest cycle. This doesn't happen too often with dentists or pianists, because of the nature of randomness. The easy way to see this is that in boom times, the highest returns often go to those who take the most risk. That doesn't say anything about their being the best investors. Warren Buffett's appendix to the fourth revised edition of The Intelligent Investor describes a contest in which each of the 225 million Americans starts with $1 and flips a coin once a day. The people who get it right on day one collect $1 from those who were wrong and go on to flip again on day two, and so forth. 10 days later, 220,000 people have called it right 10 times in a row and won $1,000. They may try to be modest, but at cocktail parties they will occasionally admit to attractive members of the opposite sex what their technique is, and what marvelous insights they bring to the field of flipping. After another 10 days, we're down to 215 survivors who've been right 20 times in a row and have each won $1 million. They write books titled like How I Turned $1 into $1 Million in 20 Days, working 30 seconds a morning, and sell tickets to seminars. Sound familiar? Thus, randomness contributes to, or wrecks, investment records to a degree that few people appreciate fully. As a result, the dangers that lurk in thus far successful strategies often are underrated. Perhaps a good way to sum up Taleb's views is by excerpting from a table in his book. He lists in the first column a number of things that easily can be mistaken for the things in the second column. Luck, skill, randomness. Determinism, probability, certainty, belief, conjecture, knowledge, certitude, theory, reality. Anecdote, coincidence, causality, law, survivorship, bias, market outperformance, lucky, idiot, skilled investor. I think this dichotomization is sheer brilliance. We all know that when things go right, luck looks like skill. Coincidence looks like causality. A lucky idiot looks like a skilled investor. Of course, knowing that randomness can have this effect doesn't make it easy to distinguish between lucky investors and skillful investors. But we must keep trying. I find that I agree with essentially all of Taleb's important points. Investors are right and wrong all the time for the wrong reason. Someone buys a stock because he or she expects a certain development, it doesn't occur, the market takes the stock up anyway, the investor looks good, and invariably accepts credit. The correctness of a decision can't be judged from the outcome. Nevertheless, that's how people assess it. A good decision is one that's optimal at the time it's made, when the future is by definition unknown. Thus, correct decisions are often unsuccessful, and vice versa. Randomness alone can produce just about any outcome in the short run. In portfolios that are allowed to reflect them fully, market movements can easily swamp the skillfulness of the manager, or lack thereof. But certainly market movements cannot be credited to the manager, unless he or she is the rare market timer who's capable of getting it right repeatedly. For these reasons, investors often receive credit they don't deserve. One good coup can be enough to build a reputation, but clearly a coup can arise out of randomness alone. Few of these geniuses are right more than once or twice in a row. Thus, it's essential to have a large number of observations, lots of years of data, before judging a given manager's ability. Returns and how they get that way. November 11, 2002. Taleb's idea of alternative histories, the other things that reasonably could have happened, is a fascinating concept, and one that is particularly relevant to investing. Most people acknowledge the uncertainty that surrounds the future, but they feel that at least the past is known and fixed. After all, the past is history, absolute and unchanging. But Taleb points out that the things that happened are only a small subset of the things that could have happened. Thus, the fact that a stratagem or action worked, under the circumstances that unfolded, doesn't necessarily prove the decision behind it was wise. Maybe what ultimately made the decision a success was a completely unlikely event, something that was just a matter of luck. In that case, that decision, as successful as it turned out to be, may have been unwise, and the many other histories that could have happened would have shown the error of the decision. How much credit should a decision maker receive for having bet on a highly uncertain outcome that unfolded luckily? This is a good question, and it deserves to be looked at in depth. One of the first things I remember learning after entering Wharton in 1963 was that the quality of a decision is not determined by the outcome. The events that transpire afterward make decisions successful or unsuccessful, and those events are often well beyond anticipating. This idea was powerfully reinforced when I read Taleb's book. He highlights the ability of chance occurrences to reward unwise decisions and penalize good ones. What is a good decision? Let's say someone decides to build a ski resort in Miami, and 3 months later a freak blizzard hits South Florida, dumping 12 feet of snow. In its first season, the ski area turns a hefty profit. Does that mean building it was a good decision? No. A good decision is one that a logical, intelligent and informed person would have made under the circumstances as they appeared at the time, before the outcome was known. By that standard, the Miami ski resort looks like folly. As with risk of loss, many things that will bear on the correctness of a decision cannot be known or quantified in advance. Even after the fact, it can be hard to be sure who made a good decision based on solid analysis but was penalized by a freak occurrence, and who benefited from taking a flyer. Thus, it can be hard to know who made the best decision. On the other hand, past returns are easily assessed, making it easy to know who made the most profitable decision. It's easy to confuse the two, but insightful investors must be highly conscious of the difference. In the long run, there's no reasonable alternative to believing that good decisions will lead to investment profits. In the short run, however, we must be stoic when they don't. Since the investors of the "I know" school, described in Chapter 14, feel it's possible to know the future, they decide what it will look like, build portfolios designed to maximize returns under that one scenario, and largely disregard the other possibilities. The suboptimizers of the "I don't know" school, on the other hand, put their emphasis on constructing portfolios that will do well in the scenarios they consider likely and not too poorly in the rest. Investors who belong to the "I know" school predict how the dice will come up, attribute their successes to their astute sense of the future, and blame bad luck when things don't go their way. When they're right, the question that has to be asked is, could they really have seen the future or couldn't they? Because their approach is probabilistic, investors of the "I don't know" school understand that the outcome is largely up to the gods, and thus that the credit or blame accorded the investors, especially in the short run, should be appropriately limited. The "I know" school quickly and confidently divides its members into winners and losers based on the first roll or two of the dice. Investors of the "I don't know" school understand that their skill should be judged over a large number of rolls, not just one, and that rolls can be few and far between. Thus they accept that their cautious, sub-optimizing approach may produce undistinguished results for a while, but they're confident that if they're superior investors, that will be apparent in the long run. Short-term gains and short-term losses are potential imposters, as neither is necessarily indicative of real investment ability, or the lack thereof. Surprisingly good returns are often just the flip side of surprisingly bad returns. One year with a great return can overstate the manager's skill and obscure the risk he or she took. Yet people are surprised when that great year is followed by a terrible year. Investors invariably lose track of the fact that both short-term gains and short-term losses can be imposters, and of the importance of digging deep to understand what underlies them. Investment performance is what happens to a portfolio when events unfold. People pay great heed to the resulting performance, but the questions they should ask are, were the events that unfolded, and the other possibilities that didn't unfold, truly within the ken of the portfolio manager? And what would the performance have been if other events had occurred instead? Those other events are Taleb's alternative histories. Pigweed, December 7, 2006. I find Taleb's ideas novel and provocative. Once you realize the vast extent to which randomness can affect investment outcomes, you look at everything in a very different light. The actions of the "I know" school are based on a view of a single future that is knowable and conquerable. My "I don't know" school thinks of future events in terms of a probability distribution. That's a big difference. In the latter case, we may have an idea which one outcome is most likely to occur, but we also know there are many other possibilities, and those other outcomes may have a collective likelihood much higher than the one we consider most likely. Clearly, Taleb's view of an uncertain world is much more consistent with mine. Everything I believe and recommend about investing proceeds from that school of thought. We should spend our time trying to find value among the knowable industries, companies, and securities, rather than base our decisions on what we expect from the less knowable macro world of economies and broad market performance. Given that we don't know exactly which future we'll obtain, we have to get value on our side by having a strongly held, analytically derived opinion of it and buying for less when opportunities to do so present themselves. We have to practice defensive investing, since many of the outcomes are likely to go against us. It's more important to ensure survival under negative outcomes than it is to guarantee maximum returns under favorable ones. To improve our chances of success, we have to emphasize acting contrary to the herd when it's at extremes, being aggressive when the market is low and cautious when it's high. Given the highly indeterminate nature of outcomes, we must view strategies and their results, both good and bad, with suspicion until proved out over a large number of trials. Several things go together for those who view the world as an uncertain place: healthy respect for risk, awareness that we don't know what the future holds, an understanding that the best we can do is view the future as a probability distribution and invest accordingly, insistence on defensive investing, and emphasis on avoiding pitfalls. To me, that's what thoughtful investing is all about. Chapter 17. The most important thing is investing defensively. There are old investors, and there are bold investors, but there are no old bold investors. When friends ask me for personal investment advice, my first step is to try to understand their attitude toward risk and return. Asking for investment advice without specifying that is like asking a doctor for a good medicine without telling him or her what ails you. So I ask, which do you care about more, making money or avoiding losses? The answer is invariably the same: both. The problem is that you can't simultaneously go all out for both profit-making and loss avoidance. Each investor has to take a position regarding these two goals, and usually that requires striking a reasonable balance. The decision should be made consciously and rationally. This chapter's about the choice and my recommendation. The best way to put this decision into perspective is by thinking of it in terms of offense versus defense. And one of the best ways to consider this is through the metaphor of sports. 2. Establish the groundwork for this discussion. I'll refer to the wonderful article by Charles Ellis, titled "The Loser's Game," that appeared in the Financial Analyst's Journal in 1975. This may have been my first exposure to a direct analogy between investing and sports, and it was absolutely seminal regarding my emphasis on defensive investing. Charlie's article described the perceptive analysis of tennis contained in Extraordinary Tennis for the Ordinary Tennis Player by Dr. Simon Ramo, the R in TRW, once a conglomerate with products ranging from auto parts to credit reporting services. Ramo pointed out that professional tennis is a winner's game, in which the match goes to the player who's able to hit the most winners, fast-paced, well-placed shots that an opponent can't return. Given anything other than an outright winner by an opponent, professional tennis players can make the shot they want almost all the time, hard or soft, deep or short, left or right, flat or with spin. Professional players aren't troubled by the things that make the game challenging for amateurs: bad bounces, wind, sun in the eyes, limitations on speed, stamina and skill, or an opponent's efforts to put the ball beyond reach. The pros can get to most shots their opponents hit and do what they want with the ball almost all the time. In fact, pros can do this so consistently that tennis statisticians keep track of the relatively rare exceptions under the heading "unforced errors." But the tennis the rest of us play is a loser's game, with the match going to the player who hits the fewest losers. The winner just keeps the ball in play until the loser hits it into the net or off the court. In other words, in amateur tennis, points aren't won, they're lost. I recognized in Ramo's loss avoidance strategy the version of tennis I try to play. Charlie Ellis took Ramo's idea a step further, applying it to investments. His views on market efficiency and the high cost of trading led him to conclude that the pursuit of winners in the mainstream stock markets is unlikely to pay off for the investor. Instead, you should try to avoid hitting losers. I found this view of investing absolutely compelling. The choice between offense and defense investing should be based on how much the investor believes is within his or her control. In my view, investing entails a lot that isn't. Professional tennis players can be quite sure that if they do A, B, C and D with their feet, body, arms and racket, the ball will do E just about every time. There are relatively few random variables at work. But investing is full of bad bounces and unanticipated developments, and the dimensions of the court and the height of the net change all the time. The workings of economies and markets are highly imprecise and variable, and the thinking and behavior of the other players constantly alter the environment. Even if you do everything right, other investors can ignore your favorite stock, management can squander the companies. Opportunities, government can change the rules, or nature can serve up a catastrophe. So much is within the control of professional tennis players that they really should go for winners. And they'd better, since if they serve up easy balls, their opponents will hit winners of their own and take points. In contrast, investment results are only partly within the investor's control, and investors can make good money, and outlast their opponents, without trying tough shots. The bottom line is that even highly skilled investors can be guilty of mishits, and the over-aggressive shot can easily lose them the match. Thus, defense, significant emphasis on keeping things from going wrong, is an important part of every great investor's game. There are a lot of things I like about investing, and most of them are true of sports as well. It's competitive, some succeed and some fail, and the distinction is clear. It's quantitative, you can see the results in black and white. It's a meritocracy, in the long term, the better returns go to the superior investors. It's team-oriented, an effective group can accomplish more than one person. It's satisfying and enjoyable, but much more so when you win. These positives can make investing a very rewarding activity in which to engage. But as in sports, there are also negatives. There can be a premium on aggressiveness, which doesn't serve well in the long run. Unlucky bounces can be frustrating. Short-term success can lead to widespread recognition without enough attention being paid to the likely durability and consistency of the record. Overall, I think investing in sports are quite similar, and so are the decisions they call for. Think about an American football game. The offense has the ball. They have 4 tries to make 10 yards. If they don't, the referee blows the whistle. The clock stops. Off the field goes the offense and on comes the defense, whose job it is to stop the other team from advancing the ball. Is football a good metaphor for your view of investing? Well, I'll tell you, it isn't for mine. In investing, there's no one there to blow the whistle, you rarely know when to switch from offense to defense, and there aren't any time outs during which to do it. No, I think investing is more like the football that's played outside the United States, soccer. In soccer, the same 11 players are on the field for essentially the whole game. There isn't an offensive squad and a defensive squad. The same people have to play both ways, have to be able to deal with all eventualities. Collectively, those 11 players must have the potential to score goals and stop the opposition from scoring more. A soccer coach has to decide whether to field a team that emphasizes offense, in order to score a lot of goals and somehow hold the other team to fewer, or defense, hoping to shut out the other team and find the net once, or one that's evenly balanced. Because coaches know they won't have many opportunities to switch between offensive and defensive personnel during the game, they have to come up with a winning lineup and pretty much stick with it. That's my view of investing. Few people, if any, have the ability to switch tactics to match market conditions on a timely basis. So investors should commit to an approach, hopefully one that will serve them through a variety of scenarios. They can be aggressive, hoping they'll make a lot on the winners and not give it back on the losers. They can emphasize defense, hoping to keep up in good times and excel by losing less than others in bad times. Or they can balance offense and defense, largely giving up on tactical timing but aiming to win through superior security selection in both up and down markets. Oaktree's preference for defense is clear. In good times, we feel it's okay if we just keep up with the indices, and in the best of times we may even lag a bit. But even average investors make a lot of money in good times, and I doubt many managers get fired for being average in up markets. Oaktree portfolios are set up to outperform in bad times, and that's when we think outperformance is essential. Clearly, if we can keep up in good times and outperform in bad times, we'll have above-average results over full cycles with below-average volatility, and our clients will enjoy outperformance when others are suffering. What's your game plan? September 5, 2003. What's more important to you, scoring points or keeping your opponent from doing so? In investing, will you go for winners or try to avoid losers? Or, perhaps more appropriately, how? Will you balance the two? Great danger lies in acting without having considered these questions. And, by the way, there's no right choice between offense and defense. Lots of possible routes can bring you to success, and your decision should be a function of your personality and leanings, the extent of your belief in your ability, and the peculiarities of the markets you work in and the clients you work for. What is offense in investing, and what is defense? Offense is easy to define. It's the adoption of aggressive tactics and elevated risk in the pursuit of above-average gains. But what's defense? Rather than doing the right thing, the defensive investor's main emphasis is on not doing the wrong thing. Is there a difference between doing the right thing and avoiding doing the wrong thing? On the surface, they sound quite alike. But when you look deeper, there's a big difference between the mind set needed for one and the mind set needed for the other, and a big difference in the tactics to which the two lead. While defense may sound like little more than trying to avoid bad outcomes, it's not as negative or non-aspirational as that. Defense actually can be seen as an attempt at higher returns, but more through the avoidance of minuses than through the inclusion of pluses, and more through consistent but perhaps moderate progress than through occasional flashes of brilliance. There are two principal elements in investment defense. The first is the exclusion of losers from portfolios. This is best accomplished by conducting extensive due diligence, applying high standards, demanding a low price and generous margin for error, see later in this chapter, and being less willing to bet on continued prosperity, rosy forecasts and developments that may be uncertain. The second element is the avoidance of poor years and, especially, exposure to meltdown in crashes. In addition to the ingredients described previously that help keep individual losing investments from the portfolio, this aspect of investment defense requires thoughtful portfolio diversification, limits on the overall riskiness borne, and a general tilt toward safety. Concentration, the opposite of diversification, and leverage are two examples of offense. They'll add to returns when they work but prove harmful when they don't, again, the potential for higher highs and lower lows from aggressive tactics. Use enough of them, however, and they can jeopardize your investment survival if things go awry. Defense, on the other hand, can increase your likelihood of being able to get through the tough times and survive long enough to enjoy the eventual payoff from smart investments. Investors must brace for untoward developments. There are lots of forms of financial activity that reasonably can be expected to work on average, but they might give you one bad day on which you melt down because of a precarious structure or excess leverage. But is it really that simple? It's easy to say you should prepare for bad days. But how bad? What's the worst case, and must you be equipped to meet it every day? Like everything else in investing, this isn't a matter of black and white. The amount of risk you'll bear is a function of the extent to which you choose to pursue return. The amount of safety you build into your portfolio should be based on how much potential return you're willing to forego. There's no right answer, just trade-offs. That's why I added this concluding thought in December 2007, because ensuring the ability to survive under adverse circumstances is incompatible with maximizing returns in the good times. Investors must choose between the two. The Aviary, May 16, 2008. The critical element in defensive investing is what Warren Buffett calls margin of safety or margin for error. He seems to go back and forth between the two without making a distinction. This subject deserves considerable discussion. It's not hard to make investments that will be successful if the future unfolds as expected. There's little mystery in how to profit under the assumption that the economy will go a certain way and particular industries and companies will do better than others. Tightly targeted investments can be highly successful if the future turns out as you hope. But you might want to give some thought to how you'll fare if the future doesn't oblige. In short, what is it that makes outcomes tolerable even when the future doesn't live up to your expectations? The answer is margin for error. Think about what happens when a lender makes a loan. It's not hard to make loans that will be repaid if conditions remain as they are. Example, if there's no recession, the borrower holds on to his or her job. But what will enable that loan to be repaid even if conditions deteriorate? Once again, margin for error. If the borrower becomes jobless, the probability of the loan being repaid is greater if there are savings, saleable assets, or alternative sources of income to fall back on. These things provide the lender's margin for error. The contrast is simple. The lender who insists on margin for error and lends only to strong borrowers will experience few credit losses. But this lender's high standards will cause him or her to forego lending opportunities, which will go to lenders who are less insistent on creditworthiness. The aggressive lender will look smarter than the prudent lender, and make more money, as long as the environment remains salutary. The prudent lender's reward comes only in bad times, in the form of reduced credit losses. The lender who insists on margin for error won't enjoy the highest highs but will also avoid the lowest lows. That's what happens to those who emphasize defense. Here's another way to illustrate margin for error. You find something you think will be worth $100. If you buy it for $90, you have a good chance of gain, as well as a moderate chance of loss in case your assumptions turn out to be too optimistic. But if you buy it for $70 instead of $90, your chance of loss is less. That $20 reduction provides additional room to be wrong and still come out okay. Low price is the ultimate source of margin for error. So the choice is simple: try to maximize returns through aggressive tactics, or build in protection through margin for error. You can't have both in full measure. Will it be offense, defense, or a mix of the two, and, if so, in what proportions? Of the two ways to perform as an investor, racking up exceptional gains and avoiding losses, I believe the latter is the more dependable. Achieving gains usually has something to do with being right about events that are on the come, whereas losses can be minimized by ascertaining that tangible value is present, the herd's expectations are moderate and prices are low. My experience tells me the latter can be done with greater consistency. A conscious balance must be struck between striving for return and limiting risk, between offense and defense. In fixed income, where I got my start as a portfolio manager, returns are limited and the manager's greatest contribution comes through the avoidance of loss. Because the upside is truly fixed, the only variability is on the downside, and avoiding it holds the key. Thus, distinguishing yourself as a bond investor isn't a matter of which paying bonds you hold, but largely of whether you're able to exclude bonds that don't pay. According to Graham and Dodd, this emphasis on exclusion makes fixed income investing a negative art. On the other hand, in equities and other more upside-oriented areas, avoiding losses isn't enough, potential for return must be present as well. While the fixed income investor can pretty much practice defense exclusively, the investor who moves beyond fixed income, typically in search of higher return, has to balance offense and defense. The key is that word balance. The fact that investors need offense in addition to defense doesn't mean they should be indifferent to the mix between the two. If investors want to strive for more return, they generally have to take on more uncertainty, more risk. If investors aspire to higher returns than can be achieved in bonds, they can't expect to get there through loss avoidance alone. Some offense is needed, and with offense comes increased uncertainty. A decision to go that way should be made consciously and intelligently. Perhaps more than any other one thing, Oaktree's activities are based on defense. But not to the exclusion of offense. Not. Everything we engage in is a negative art. You can't invest successfully in convertibles, distressed debt or real estate if you're not willing to think about both upside and downside. Investing is a testosterone-laden world where too many people think about how good they are and how much they'll make if they swing for the fences and connect. Ask some investors of the "I know" school to tell you what makes them good, and you'll hear a lot about home runs they've hit in the past and the home runs in the making that reside in their current portfolio. How many talk about consistency, or the fact that their worst year wasn't too bad? One of the most striking things I've noted over the last 35 years is how brief most outstanding investment careers are. Not as short as the careers of professional athletes, but shorter than they should be in a physically non-destructive vocation. Where are the leading competitors from the days when I first managed high-yield bonds 25 or 30 years ago? Almost none of them are around anymore. And astoundingly, not one of our prominent distressed debt competitors from the early days 15 or 20 years ago remains a leader today. Where'd they go? Many disappeared because organizational flaws rendered their game plans unsustainable. And the rest are gone because they swung for the fences but struck out instead. That brings up something that I consider a great paradox. I don't think many investment managers' careers end because they fail to hit home runs. Rather, they end up out of the game because they strike out too often, not because they don't have enough winners, but because they have too many losers. And yet, lots of managers keep swinging for the fences. They bet too much when they think they have a winning idea or a correct view of the future, concentrating their portfolios rather than diversifying. They incur excessive transaction costs by changing their holdings too often or attempting to time the market. And they position their portfolios for favorable scenarios and hoped-for outcomes, rather than ensuring that they'll be able to survive the inevitable miscalculation or stroke of bad luck. At Oaktree, on the other hand, we believe firmly that, if we avoid the losers, the winners will take care of themselves. That's been our motto since the beginning, and it always will be. We go for batting average, not home runs. We know others will get the headlines for their big victories and spectacular seasons. But we expect to be around at the finish because of consistent good performance that produces satisfied clients. What's your game plan? September 5, 2003. It suggests there are gains to be had for assuming risk. The difference between the two figures, of course, is that the former doesn't indicate the great uncertainty entailed in bearing increased risk, while the latter does. As it makes clear, riskier investments entail wider ranges of outcomes, including the possibility of losses instead of the hoped-for gains. Playing offense, trying for winners through risk-bearing, is a high-octane activity. It might bring the gains you seek or pronounced disappointment. And here's something else to think about: the more challenging and potentially lucrative the waters you fish in, the more likely they are to have attracted skilled fishermen. Unless your skills render you fully competitive, you're more likely to be prey than victor. Playing offense, bearing risk and operating in technically challenging fields mustn't be attempted without the requisite competence. In addition to technical skills, aggressive investing also requires intestinal fortitude, patient clients, if you manage money for others, and dependable capital. When developments become adverse, you'll need these things to get through. Investment decisions may have the potential to work out in the long run or on average, but without these things, the aggressive investor may not get to see the long run. Operating a high-risk portfolio is like performing on the high wire without a net. The payoff for success may be high and bring oohs and ahs. But those slip-ups will kill you. The bottom line on striving for superior performance has a lot to do with daring to be great. One of the investor's first and most fundamental decisions has to be on the question of how far out the portfolio will venture. How much emphasis should be put on diversifying, avoiding loss and ensuring against below-pack performance, and how much on sacrificing these things in the hope of doing better? I learned a lot from my favorite fortune cookie, the cautious seldom err or write great poetry. It cuts two ways, which makes it thought-provoking. Caution can help us avoid mistakes, but it can also keep us from great accomplishments. Personally, I like caution in money managers. I believe that in many cases, the avoidance of losses and terrible years is more easily achieved than repeated greatness, and thus risk control is more likely to create a solid foundation for a superior long-term track record. Investing scared, requiring good value and a substantial margin for error, and being conscious of what you don't know and can't control are hallmarks of the best investors I know. Dare to be great, September 7th. 2006. The choice between offense and defense, like so many in this book, defies an easy answer. For example, consider this conundrum: many people seem unwilling to do enough of anything, example, buy a stock, commit to an asset class or invest with a manager, such that it could significantly harm their results if it doesn't work. But in order for something to be able to materially help your return if it succeeds, you have to do enough so that it could materially hurt you if it fails. In investing, almost everything is a two-edged sword. That goes for opting to take bigger risks, substituting concentration for diversification and using leverage to magnify gains. The only exception is genuine personal skill. As for all the rest, if it'll help if it works, that means it'll hurt if it doesn't. That's what makes the choice between offense and defense important and challenging. Many see this decision as the choice between aspiring for more and settling for less. For the thoughtful investor, however, the answer is that defense can provide good returns achieved consistently, while offense may consist of dreams that often go unmet. For me, defense is the way to go. Investing defensively can cause you to miss out on things that are hot and get hotter, and it can leave you with your bat on your shoulder in trip after trip to the plate. You may hit fewer home runs than another investor, but you're also likely to have fewer strikeouts and fewer inning-ending double plays. Defensive investing sounds very erudite, but I can simplify it: invest scared. Worry about the possibility of loss. Worry that there's something you don't know. Worry that you can make high-quality decisions but still be hit by bad luck or surprise events. Investing scared will prevent hubris, will keep your guard up and your mental adrenaline flowing, will make you insist on adequate margin of safety, and will increase the chances that your portfolio is prepared for things going wrong. And if nothing does go wrong, surely the winners will take care of themselves. The most important thing, July 1st, 2003. Chapter 18. The most important thing is avoiding pitfalls. An investor needs do very few things right as long as he avoids big mistakes. Warren Buffett. In my book, trying to avoid losses is more important than striving for great investment successes. The latter can be achieved some of the time, but the occasional failures may be crippling. The former can be done more often and more dependably and with consequences when it fails that are more tolerable. With a risky portfolio, a downward fluctuation may make you lose faith or be sold out at the low. A portfolio that contains too little risk can make you underperform in a bull market, but no one ever went bust from that. There are far worse fates. To avoid losses, we need to understand and avoid the pitfalls that create them. In this chapter 1 bring together some of the key issues discussed in earlier chapters, in the hope that highlighting them under one umbrella will help investors become more alert for trouble spots. The starting point consists of realizing that many kinds of pitfalls exist and learning what they look like. I think of the sources of error as being primarily analytical/intellectual or psychological/emotional. The former are straightforward: we collect too little information or incorrect information. Or perhaps we apply the wrong analytical processes, make errors in our computations, or omit ones we should have performed. There are far too many errors of this sort for me to enumerate, and anyway, this book is more about philosophy and mindset than it is about analytical processes. One type of analytical error that I do want to spend some time on, however, is what I call failure of imagination. By that I mean either being unable to conceive of the full range of possible outcomes or not fully understanding the consequences of the more extreme occurrences. I go into this subject at greater length in the next section. Many of the psychological or emotional sources of error were discussed in previous chapters: greed and fear, willingness to suspend disbelief, and skepticism, ego and envy, the drive to pursue high returns through risk-bearing, and the tendency to overrate one's foreknowledge. These things contribute to booms and busts, in which most investors join together to do exactly the wrong thing. Another important pitfall, largely psychological, but important enough to constitute its own category, is the failure to recognize market cycles and manias and move in the opposite direction. Extremes in cycles and trends don't occur often, and thus they're not a frequent source of error, but they give rise to the largest errors. The power of herd psychology to compel conformity and capitulation is nearly irresistible, making it essential that investors resist them. These, too, were discussed earlier. Failure of imagination, the inability to understand in advance the full breadth of the range of outcomes, is particularly interesting, and it takes effect in many ways. As I've said before, investing consists entirely of dealing with the future. In order to invest, we must have a view of what the future will look like. In general, we have little choice but to assume it will look pretty much like the past. Thus, it's relatively uncommon for anyone to say, the average price/earnings ratio on U.S. stocks has been 15 over the last 50 years, and I predict that in the coming years it will be 10 or 20. So most investors extrapolate the past into the future, and, in particular, the recent past. Why the recent past? First, many important financial phenomena follow long cycles, meaning those who experience an extreme event often retire or die off before the next recurrence. Second, as John Kenneth Galbraith said, the financial memory tends to be extremely short. And third, any chance of remembering tends to be erased by the promise of easy money that's inevitably a part of the latest investment fad. Most of the time the future is indeed like the past, so extrapolation doesn't do any harm. But at the important turning points, when the future stops being like the past, extrapolation fails and large amounts of money are either lost or not made. Thus, it's important to return to Bruce Newberg's pithy observation about the big difference between probability and outcome. Things that aren't supposed to happen do happen. Short-run outcomes can diverge from the long-run probabilities, and occurrences can cluster. For example, double sixes should come up once in every 36 rolls of the dice. But they can come up 5 times in a row, and never again in the next 175 rolls, and in the long run have occurred as often as they're supposed to. Relying to excess on the fact that something should happen can kill you when it doesn't. Even if you properly understand the underlying probability distribution, you can't count on things happening as they're supposed to. And the success of your investment actions shouldn't be highly dependent on normal outcomes prevailing. Instead, you must allow for outliers. Investors make investments only because they expect them to work out, and their analysis will center on the likely scenarios. But they Mustn't fixate on that which is supposed to happen to the exclusion of the other possibilities. And load up on risk and leverage to the point where negative outcomes will do them in. Most of the meltdowns in the recent credit crisis took place because something didn't go as it was supposed to. The financial crisis occurred largely because never before seen events collided with risky, levered structures that weren't engineered to withstand them. For example, mortgage derivatives had been designed and rated on the assumption that there couldn't be a nationwide decline in home prices, since there never had been one, or at least not in the modern era of statistics. But then we had one of major proportions, and structures built on the assumption that it couldn't happen were decimated. As an aside, it's worth noting that the assumption that something can't happen has the potential to make it happen, since people who believe it can't happen will engage in risky behavior and thus alter the environment. 20 or more years ago, the term mortgage lending was associated inextricably with the word conservative. Home buyers put down 20 to 30% of the purchase price. Mortgage payments were limited to 25% of monthly income by tradition, houses were appraised carefully, and borrowers' income and financial position had to be documented. But when the appetite for mortgage-backed securities rose in the past decade, in part because mortgages had always performed so dependably and it was agreed there couldn't be a nationwide surge in mortgage defaults, many of these traditional norms went out the window. The consequences shouldn't have come as a surprise. That brings me back to a dilemma we have to navigate. How much time and capital should an investor devote to protecting against an improbable disaster? We can insure against every extreme outcome, for example, against both deflation and hyperinflation. But doing so will be costly, and the cost will detract from investment returns when that protection turns out not to have been needed, and that'll be most of the time. You could require your portfolio to do well in a rerun of 2008, but then you'd hold only treasury, cash and gold. Is that a viable strategy? Probably not. So the general rule is that it's important to avoid pitfalls, but there must be a limit. And the limit is different for each investor. There's another important aspect of failure of imagination. Everyone knows assets have prospective returns and risks, and they're possible to guess at. But few people understand asset correlation, how one asset will react to a change in another, or that two assets will react similarly to a change in a third. Understanding and anticipating the power of correlation, and thus the limitations of diversification, is a principal aspect of risk control and portfolio management, but it's very hard to accomplish. The failure to correctly anticipate movement within a portfolio is a critical source of investment error. Investors often fail to appreciate the common threads that run through portfolios. Everyone knows that if one automaker's stock falls, factors they have in common could make all auto stocks decline simultaneously. Fewer people understand the connections that could make all U.S. stocks fall, or all stocks in the developed world, or all stocks worldwide, or all stocks and bonds, etc. So failure of imagination consists in the first instance of not anticipating the possible extremeness of future events, and in the second instance of failing to understand the knock-on consequences of extreme events. In the recent credit crisis, some skeptics may have suspected that subprime mortgages would default in large numbers, but not necessarily that the ramifications would spread far beyond the mortgage market. Few people envisioned the mortgage collapse, but far fewer anticipated that as a result commercial paper and money market funds would be compromised, or that Lehman Brothers, Bear Stearns, and Merrill Lynch would cease to exist as independent companies, or that General Motors and Chrysler would file for bankruptcy and require bailouts. In many ways, psychological forces are some of the most interesting sources of investment error. They can greatly influence security prices. When they cause some investors to take an extreme view that isn't balanced out by others, these forces can make prices go way too high or way too low. This is the origin of bubbles and crashes. How are investors harmed by these forces? By succumbing to them, by participating unknowingly in markets that have been distorted by others, succumbing by failing to take advantage when those distortions are present. Are these all the same thing? I don't think so. Let's dissect these three mistakes in the context of one of the most insidious psychological forces, greed. When greed goes to excess, security prices tend to be too high. That makes prospective return low and risk high. The assets in question represent mistakes waiting to produce loss, or to be taken advantage of. The first of the three errors just listed, succumbing to negative influences, means joining in the greed and buying. If the desire to make money causes you to buy even though price is too high, in the hope that the asset will continue appreciating or the tactic will keep working, you're setting yourself up for disappointment. If you buy when price exceeds intrinsic value, you'll have to be extremely lucky. The asset will have to go from overvalued to even more overvalued, in order to experience gain rather than loss. Certainly the elevated price renders the latter more likely than the former. The second of the errors is something we might call the error of not noticing. You may not be motivated by greed. For example, your 401k plan may invest in the stock market steadily and passively through an index fund. Nevertheless, participating, even unknowingly, in a market that has become elevated because of undisciplined buying by others has serious implications for you. Each negative influence, and each kind of wrong market, presents ways to benefit instead of err. Thus, the third form of error doesn't consist of doing the wrong thing, but rather of failing to do the right thing. Average investors are fortunate if they can avoid pitfalls, whereas superior investors look to take advantage of them. Most investors would hope to not buy, or perhaps even to sell, when greed has driven a stock's price too high. But superior investors might sell it short in order to profit when the price falls. Committing the third form of error, example, failing to short an overvalued stock, is a different kind of mistake, an error of omission, but probably one most investors would be willing to live with. As I mentioned before, among the pitfalls attributable to psychology is investors' occasional willingness to accept the novel rationales that underlie bubbles and crashes, usually out of a belief that it's different this time. In bullish markets, inadequate skepticism makes this a frequent occurrence, as investors accept that some new development will change the world. Patterns that have been the rule in the past, like the ups and downs of the business cycle, will no longer occur. The rules have been changed, such as the standards that determine whether companies are creditworthy and their debt worth holding, or traditional valuation norms are no longer relevant, including price/earnings ratios for stocks, yield spreads for bonds, or capitalization rates for real estate. Because of the way the pendulum swings, see Chapter 9, these errors often occur simultaneously when investors become too believing and default on the requirement to be skeptical. There's always a rational, perhaps even a sophisticated, explanation of why some eighth wonder of the world will work in the investor's favor. However, the explainer usually forgets to mention that A. The new phenomenon would represent a departure from history, B. It requires things to go right, C. Many other things could happen instead, and D. Many of those might be disastrous. The essential first step in avoiding pitfalls consists of being on the lookout for them. The combination of greed and optimism repeatedly leads people to pursue strategies they hope will produce high returns without high risk, pay elevated prices for securities that are in vogue, and hold things after they have become highly priced in the hope there's still some appreciation left. Afterwards, hindsight shows everyone what went wrong, that expectations were unrealistic and risks were ignored. But learning about pitfalls through painful experience is of only limited help. The key is to try to anticipate them. To illustrate, I turn to the recent credit crisis. The markets are a classroom where lessons are taught every day. The keys to investment success lie in observing and learning. In December 2007, with the subprime problem well underway and its potential for contagion to other markets in the process of becoming clear, I set out to enumerate the lessons that I thought should be learned from it. By the time I completed that task, I realized that these weren't just the lessons of the latest crisis, but key lessons for all time. While I've touched on many of these elsewhere, you may benefit from seeing them all together in one place. What we learn from a crisis, or ought to, too much capital availability makes money flow to the wrong places. When capital is scarce and in demand, investors are faced with allocation choices regarding the best use for their capital, and they get to make their decisions with patience and discipline. But when there's too much capital chasing too few ideas, investments will be made that do not deserve to be made. When capital goes where it shouldn't, bad things happen. In times of capital market stringency, deserving borrowers are turned away. But when money's everywhere, unqualified borrowers are offered money on a silver platter. The inevitable results include delinquencies, bankruptcies, and losses. When capital is in oversupply, investors compete for deals by accepting low returns and a slender margin for error. When people want to buy something, their competition takes the form of an auction in which they bid higher and higher. When you think about it, bidding more for something is the same as saying you'll take less for your money. Thus, the bids for investments can be viewed as a statement of how little return investors demand and how much risk they're willing to accept. Widespread disregard for risk creates great risk. Nothing can go wrong. No price is too high. Someone will always pay me more for it. If I don't move quickly, someone else will buy it. Statements like these indicate that risk is being given short shrift. This cycle's version saw people think that because they were buying better companies or financing with more borrower-friendly debt, buyout transactions could support larger and larger amounts of leverage. This caused them to ignore the risk of untoward developments and the danger inherent in highly leveraged capital structures. Inadequate due diligence leads to investment losses. The best defense against loss is thorough, insightful analysis and insistence on what Warren Buffett calls margin for error. But in hot markets, people worry about missing out, not about losing money, and time-consuming, skeptical analysis becomes the province of old fogies. In heady times, capital is devoted to innovative investments, many of which fail the test of time. Bullish investors focus on what might work, not what might go wrong. Eagerness takes over from prudence, causing people to accept new investment products they don't understand. Later, they wonder what they could have been thinking. Hidden fault lines running through portfolios can make the prices of seemingly unrelated assets move in tandem. It's easier to assess the return and risk of an investment than to understand how it will move relative to others. Correlation is often underestimated, especially because of the degree to which it increases. In crisis, a portfolio may appear to be diversified as to asset class, industry, and geography, but in tough times, non-fundamental factors such as margin calls, frozen markets, and a general rise in risk aversion can become dominant, affecting everything similarly. Psychological and technical factors can swamp fundamentals. In the long run, value creation and destruction are driven by fundamentals such as economic trends, companies' earnings, demand for products, and the skillfulness of managements. But in the short run, markets are highly responsive to investor psychology and the technical factors that influence the supply and demand for assets. In fact, I think confidence matters more than anything else in the short run. Anything can happen in this regard, with results that are both unpredictable and irrational. Markets change, invalidating models. Accounts of the difficulties of quant funds center on the failure of computer models and their underlying assumptions. The computers that run portfolios attempt primarily to profit from patterns that held true in past markets. They can't predict changes in those patterns, they can't anticipate aberrant periods, and thus they generally overestimate the reliability of past norms. Leverage magnifies outcomes but doesn't add value. It can make great sense to use leverage to increase your investment in assets at bargain prices offering high promised returns or generous risk premiums. But it can be dangerous to use leverage to buy more of assets that offer low returns or narrow risk spreads, in other words, assets that are fully priced or overpriced. It makes little sense to use leverage to try to turn inadequate returns into adequate returns. Excess is correct. When investor psychology is extremely rosy and markets are priced for perfection, based on an assumption that things will always be good, the scene is set for capital destruction. It may happen because investors' assumptions turn out to be too optimistic, because negative events occur, or simply because too high prices collapse of their own weight. Most of these 11 lessons can be reduced to just one: be alert to what's going on around you with regard to the supply/demand balance for investable funds and the eagerness to spend them. We know what it feels like when there's too little capital around and great hesitance to part with it. Worthwhile investments can go begging, and business can slow throughout the economy. It's called a credit crunch. But the opposite deserves to receive no less attention. There's no official term for it, so too much money chasing too few ideas may have to do. Regardless of what it's called, an oversupply of capital and the accompanying dearth of prudence such as we saw in 2004 to 2007, with their pernicious effects, can be dangerous for your investing health and must be recognized and dealt with. No different this time. December 17, 2007. The global crisis provided a great opportunity to learn, since it entailed so many grave errors and offered up the lessons enumerated in my December 2007 memo. Pitfalls were everywhere, investors were unworried, even ebullient in the years leading up. People believed that risk had been banished, and thus they need worry only about missing opportunity and failing to keep up, not about losing money. Risky, untested investment innovations were adopted on the basis of shaky assumptions. Undue weight was accorded opaque models and black boxes, financial engineers and quants, and performance records compiled during salutary periods. Leverage was piled on top of leverage. Almost no one knew exactly what the consequences would be, but it was possible to have a sense that we were riding for a fall. Even though specific pitfalls may not have been susceptible to identification and avoidance, this was a perfect time to recognize that many were lurking, and thus to adopt a more defensive posture. Failure to do so was the great error of the crisis. Leading up to it, what could investors have done? The answers lay in taking note of the carefree, incautious behavior of others, preparing psychologically for a downturn, selling assets, or at least the more risk-prone ones, reducing leverage, raising cash, and returning cash to clients if you invested for others, and generally tilting portfolios toward increased defensiveness. Any of these would have helped. Although almost nothing performed well in the meltdown of 2008, it was possible as a result of elevated caution to lose less than others and reduce the pain. While it was nigh unto impossible to avoid declines completely, relative outperformance in the form of smaller losses was enough to let you do better in the decline and take greater advantage of the rebound. The crisis was rife with potential pitfalls: first, opportunities to succumb and lose, and then opportunities to go into a shell and miss out. In periods that are relatively loss-free, people tend to think of risk as volatility and become convinced they can live with it. If that were true, they would experience markdowns, invest more at the lows and go on to enjoy the recovery, coming out ahead in the long run. But if the ability to live with volatility and maintain one's composure has been overestimated, and usually it has, that error tends to come to light when the market is at its nadir. Loss of confidence and resolve can cause investors to sell at the bottom, converting downward fluctuations into permanent losses and preventing them from participating fully in the subsequent recovery. This is the greatest error in investing, the most unfortunate aspect of pro-cyclical behavior, because of its permanence and because it tends to affect large portions of portfolios. Since counter-cyclical behavior was the essential element in avoiding the full effect of the recent crisis, behaving pro-cyclically presented the greatest potential pitfall. Investors who maintained their bullish positions as the market rose, or added to them, were least prepared for the bust and the subsequent recovery. The declines had maximum psychological impact. Margin calls and confiscations of collateral decimated levered vehicles. Troubled holdings required remedial action that occupied managers. As usual, the loss of confidence prevented many from doing the right thing at the right time. While it's true that you can't spend relative outperformance, human nature causes defensive investors and their less traumatized clients to derive comfort in down markets when they lose less than others. This has two very important effects. First, it enables them to maintain their equanimity and resist the psychological pressures that often make people sell at lows. Second, being in a better frame of mind and better financial condition, they are more able to profit from the carnage by buying at lows. Thus, they generally do better in recoveries. Certainly, this is what happened in the last few years. The credit markets were particularly hard hit in 2007 to 2008, since they had been the focus of innovation, risk-taking in the use of leverage. Correspondingly, their gains in 2009 were the best in their history. Surviving the declines and buying at the resultant lows was a great formula for success, especially relative success, but first it required the avoidance of pitfalls. The formula for error is simple, but the ways it appears are infinite. Far too many to allow enumeration. Here are the usual ingredients. Data or calculation error in the analytical process leads to incorrect appraisal of value, the full range of possibilities. Or their consequences is underestimated. Greed, fear, envy, ego, suspension of disbelief, conformity or capitulation, or some combination of these, moves to an extreme. As a result, either risk-taking or risk avoidance becomes excessive, prices diverge significantly from value, and investors fail to notice this divergence, and perhaps contribute to its furtherance. Ideally, astute and prudent second-level thinkers take note of the analytical error as well as the failure of other investors to react appropriately. They detect over- or underpriced assets in the context of too hot or too cool markets. They set their course to avoid the mistakes others are making and hopefully take advantage instead. The upshot of investment error is simple to define: prices that differ from intrinsic value. Detecting it and acting on it are less simple. The fascinating and challenging thing is that the error moves around. Sometimes prices are too high and sometimes they're too low. Sometimes the divergence of price from value affects individual securities or assets and sometimes whole markets, sometimes one market and sometimes another. Sometimes the error lies in doing something and sometimes in not doing it, sometimes in being bullish and sometimes in being bearish. And, of course, by definition most people go along with the error, since without their concurrence it couldn't exist. Acting in the opposite direction requires the adoption of a contrarian position, with the loneliness and feeling of being wrong that it can bring for long periods. As with the rest of the tasks discussed in this book, avoiding pitfalls and identifying and acting on error aren't susceptible to rules, algorithms, or roadmaps. What I would urge is awareness, flexibility, adaptability, and a mind set that is focused on taking cues from the environment. One way to improve investment results, which we try hard to apply at Oaktree, is to think about what today's mistake might be and try to avoid it. There are times in investing when the likely mistake consists of not buying enough, not making one more bid in an auction, holding too much cash, not using enough leverage, or not taking enough risk. I don't think that describes 2004. I've always heard that no one awaiting heart surgery ever complained, "I wish I'd gone to the office more." Well, likewise I don't think anyone in the next few years is going to look back and say, "I wish I'd invested more in 2004." Rather, I think this year's mistake is going to turn out to be buying too much, buying too aggressively, making one bid too many, using too much leverage, and taking too much risk in the pursuit of superior returns. There are times when the investing errors are of omission, the things you should have done but didn't. Today I think the errors are probably of commission, the things you shouldn't have done but did. There are times for aggressiveness. I think this is a time for caution. Risk and Return today, October 27, 2004. Finally, it's important to bear in mind that in addition to times when the errors are of commission, example, buying, and times when they are of omission, failing to buy, there are times when there's no glaring error. When investor psychology is at equilibrium and fear and greed are balanced, asset prices are likely to be fair relative to value. In that case there may be no compelling action, and it's important to know that, too. When there's nothing particularly clever to do, the potential pitfall lies in insisting on being clever. Chapter 19. The most important thing is adding value. The performance of investors who add value is asymmetrical. The percentage of the market's gain they capture is higher than the percentage of loss they suffer. Only skill can be counted on to add more in propitious environments than it costs in hostile ones. This is the investment asymmetry we seek. It's not hard to perform in line with the market in terms of risk and return. The trick is to do better than the market, to add value. This calls for superior investment skill, superior insight. So here, near the end of the book, we come around full circle to the first chapter and second-level thinkers possessing exceptional skill. The purpose of this chapter is to explain what it means for skillful investors to add value. To accomplish that, I'm going to introduce two terms from investment theory. One is beta, a measure of a portfolio's relative sensitivity to market movements. The other is alpha, which I define as personal investment skill, or the ability to generate performance that is unrelated to movement of the market. As I mentioned earlier, it's easy to achieve the market return. A passive index fund will produce just that result by holding every security in a given market index in proportion to its equity capitalization. Thus, it mirrors the characteristics, example, upside potential, downside risk, beta, or volatility, growth, richness or cheapness, quality or lack of same, of the selected index and delivers its return. It epitomizes investing without value added. Let's say, then, that all equity investors start not with a blank sheet of paper but rather with the possibility of simply emulating an index. They can go out and passively buy a market-weighted amount of each stock in the index, in which case their performance will be the same as that of the index. Or they can try for outperformance through active rather than passive investing. Active investors have a number of options available to them. First, they can decide to make their portfolio more aggressive or more defensive than the index, either on a permanent basis or in an attempt at market timing. If investors choose aggressiveness, for example, they can increase their portfolio's market sensitivity by overweighting those stocks in the index that typically fluctuate more than the rest, or by utilizing leverage. Doing these things will increase the systematic riskiness of a portfolio, its beta. However, theory says that while this may increase a portfolio's return, the return differential will be fully explained by the increase in systematic risk borne. Thus doing these things won't improve the portfolio's risk-adjusted return. Second, investors can decide to deviate from the index in order to exploit their stock-picking ability, buying more of some stocks in the index, underweighting or excluding others, and adding some stocks that aren't part of the index. In doing so they will alter the exposure of their portfolios to specific events that occur at individual companies, and thus to price movements that affect only certain stocks, not the whole index. As the composition of their portfolios diverges from the index for non-systematic, we might say idiosyncratic, reasons, their return will deviate as well. In the long run, however, unless the investors have superior insight, these deviations will cancel out, and their risk-adjusted performance will converge with that of the index. Active investors who don't possess the superior insight described in Chapter 1 are no better than passive investors, and their portfolios shouldn't be expected to perform better than a passive portfolio. They can try hard, put their emphasis on offense or defense, or trade up a storm, but their risk-adjusted performance shouldn't be expected to be better than the passive portfolio. And it could be worse due to non-systematic risks borne and transaction costs that are unavailing. That doesn't mean that if the market index goes up 15%, every non-value added active investor should be expected to achieve a 15% return. They'll all hold different active portfolios, and some will perform better than others, just not consistently or dependably. Collectively they'll reflect the composition of the market, but each will have its own peculiarities. Pro-risk, aggressive. Investors, for example, should be expected to make more than the index in good times and lose more in bad times. This is where beta comes in. By the word beta, theory means relative volatility, or the relative responsiveness of the portfolio return to the market return. A portfolio with a beta above 1 is expected to be more volatile than the reference market, and a beta below 1 means it'll be less volatile. Multiply the market return by the beta and you'll get the return that a given portfolio should be expected to achieve, omitting unsystematic sources of risk. If the market is up 15%, a portfolio with a beta of 1.2 should return 18%, plus or minus alpha. Theory looks at this information and says the increased return is explained by the increase in beta, or systematic risk. It also says returns don't increase to compensate for risk other than systematic risk. Why don't they? According to theory, the risk that markets compensate for is the risk that is intrinsic and inescapable in investing, systematic or non-diversifiable risk. The rest of risk comes from decisions to hold individual stocks, unsystematic risk. Since that risk can be eliminated by diversifying, why should investors be compensated with additional return for bearing it? According to theory, then, the formula for explaining portfolio performance, Y, is as follows: Y equals alpha plus beta x. Here alpha is the symbol for alpha, beta stands for beta, and x is the return of the market. The market-related return of the portfolio is equal to its beta times the market return, and alpha, skill-related return, is added to arrive at the total return. Of course, theory says there's no such thing as alpha. Although I dismiss the identity between risk and volatility, I insist on considering a portfolio's return in the light of its overall riskiness, as discussed earlier. A manager who earned 18% with a risky portfolio isn't necessarily superior to one who earned 15% with a lower risk portfolio. Risk-adjusted return holds the key, even though, since risk other than volatility can't be quantified, I feel it is best assessed judgmentally, not calculated scientifically. Of course, I also dismiss the idea that the alpha term in the equation has to be zero. Investment skill exists, even though not everyone has it. Only through thinking about risk-adjusted return might we determine whether an investor possesses superior insight, investment skill, or alpha, that is, whether the investor adds value. It's important to keep these considerations in mind when assessing an investor's skill and when comparing the record of a defensive investor and an aggressive investor. You might call this process style adjusting. In a bad year, defensive investors lose less than aggressive investors. Did they add value? Not necessarily. In a good year, aggressive investors make more than defensive investors. Did they do a better job? Few people would say yes without further investigation. A single year says almost nothing about skill, especially when the results are in line with what would be expected on the basis of the investor's style. It means relatively little that a risk-taker achieves a high return in a rising market, or that a conservative investor is able to minimize losses in a decline. The real question is how they do in the long run and in climates for which their style is ill-suited. A 2-by-2 matrix tells the story. Aggressive investor, defensive investor without skill gains a lot when the market goes up, and loses a lot when the market goes down. Doesn't lose much when the market goes down, but doesn't gain much when the market goes up. With skill gains a lot when the market goes up, but doesn't lose to the same degree when the market goes down. Doesn't lose much when the market goes down, but captures a fair bit of the gain when the market goes up. The key to this matrix is the symmetry or asymmetry of the performance. Investors who lack skill simply earn the return of the market and the dictates of their style. Without skill, aggressive investors move a lot in both directions, and defensive investors move little in either direction. These investors contribute nothing beyond their choice of style. Each does well when his or her style is in favor but poorly when it isn't. On the other hand, the performance of investors who add value is asymmetrical. The percentage of the market's gain they capture is higher than the percentage of loss they suffer. Aggressive investors with skill do well in bull markets but don't give it all back in corresponding bear markets, while defensive investors with skill lose relatively little in bear markets but participate reasonably in bull markets. Everything in investing is a two-edged sword and operates symmetrically, with the exception of superior skill. Only skill can be counted on to add more in propitious environments than it costs in hostile ones. This is the investment asymmetry we seek. Superior skill is the prerequisite for it. Here's how I describe Oaktree's performance aspirations. In good years in the market, it's good enough to be average. Everyone makes money in the good years, and I have yet to hear anyone explain convincingly why it's important to beat the market when the market does well. No, in the good years average is good enough. There is a time, however, when we consider it essential to beat the market, and that's in the bad years. Our clients don't expect to bear the full brunt of market losses when they occur, and neither do we. Thus, it's our goal to do as well as the market, and it does well and better than the market when it does poorly. At first blush, that may sound like a modest goal, but it's really quite ambitious. In order to stay up with the market when it does well, a portfolio has to incorporate good measures of beta and correlation with the market. But if we're aided by beta and correlation on the way up, shouldn't they be expected to hurt us on the way down? If we're consistently able to decline less when the market declines and also participate fully when the market rises, this can be attributable to only one thing: alpha, or skill. That's an example of value-added investing, and if demonstrated over a period of decades, it has to come from investment skill. Asymmetry, better performance on the upside than on the downside relative to what your style alone would produce, should be every investor's goal. Chapter 20. The most important thing is pulling it all together. The best foundation for a successful investment, or a successful investment career, is value. You must have a good idea of what the thing you're considering buying is worth. There are many components to this and many ways to look at it. To oversimplify, there's cash on the books and the value of the tangible assets, the ability of the company or asset to generate cash, and the potential for these things to increase. To achieve superior investment results, your insight into value has to be superior. Thus you must learn things others don't, see things differently, or do a better job of analyzing them, ideally, all three. Your view of value has to be based on a solid factual and analytical foundation, and it has to be held firmly. Only then will you know when to buy or sell. Only a strong sense of value will give you the discipline needed to take profits on a highly appreciated asset that everyone thinks will rise non-stop, or the guts to hold an average down in a crisis even as prices go lower every day. Of course, for your efforts in these regards to be profitable, your estimate of value has to be on target. The relationship between price and value holds the ultimate key to investment success. Buying below value is the most dependable route to profit. Paying above value rarely works out as well. What causes an asset to sell below its value? Outstanding buying opportunities exist primarily because perception understates reality. Whereas high quality can be readily apparent, it takes keen insight to detect cheapness. 4. This reason, investors often mistake objective merit for investment opportunity. The superior investor never forgets that the goal is to find good buys, not good assets. In addition to giving rise to profit potential, buying when price is below value is a key element in limiting risk. Neither paying up for high growth nor participating in a hot momentum market can do the same. The relationship between price and value is influenced by psychology and technicals, forces that can dominate fundamentals in the short run. Extreme swings in price due to those two factors provide opportunities for big profits or big mistakes. To have it be the former rather than the latter, you must stick with the concept of value and cope with psychology and technicals. Economies and markets cycle up and down. Whichever direction they're going at the moment, most people come to believe that they'll go that way forever. This thinking is a source of great danger since it poisons the markets, sends valuations to extremes, and ignites bubbles and panics that most investors find hard to resist. Likewise, the psychology of the investing herd moves in a regular, pendulum-like pattern, from optimism to pessimism, from credulousness to skepticism, from fear of missing opportunity to fear of losing money, and thus from eagerness to buy to urgency to sell. The swing of the pendulum causes the herd to buy at high prices and sell at low prices. Thus, being part of the herd is a formula for disaster, whereas contrarianism at the extremes will help to avert losses and lead eventually to success. In particular, risk aversion, an appropriate amount of which is the essential ingredient in a rational market, is sometimes in short supply and sometimes excessive. The fluctuation of investor psychology in this regard plays a very important part in the creation of market bubbles and crashes. The power of psychological influences must never be underestimated. Greed, fear, suspension of disbelief, conformism, envy, ego, and capitulation are all part of human nature, and their ability to compel action is profound, especially when they're at extremes and shared by the herd. They'll influence others, and the thoughtful investor will feel them as well. None of us should expect to be immune and insulated from them. Although we will feel them, we must not succumb, rather, we must recognize them for what they are and stand against them. Reason must overcome emotion. Most trends, both bullish and bearish, eventually become overdone, profiting those who recognize them early but penalizing the last to join. That's the reasoning behind my number one investment adage, what the wise man does in the beginning, the fool does in the end. The ability to resist excesses is rare, but it's an important attribute of the most successful investors. It's impossible to know when an overheated market will turn down, or when a downturn will cease and appreciation will take its place. But while we never know where we're going, we ought to know where we are. We can infer where markets stand in their cycle from the behavior of those around us. When other investors are unworried, we should be cautious. When investors are panicked, we should turn aggressive. Not even contrarianism, however, will produce profits all the time. The great opportunities to buy and sell are associated with valuation extremes, and by definition they don't occur every day. We're bound to also buy and sell at less compelling points in the cycle, since few of us can be content to act only once every few years. We must recognize when the odds are less in our favor and tread more carefully. Buying based on strong value, low price relative to value, and depressed general psychology is likely to provide the best results. Even then, however, things can go against us for a long time before turning as we think they should. Underpriced is far from synonymous with going up soon. Thus the importance of my second key adage, being too far ahead of your time, is indistinguishable from being wrong. It can require patience and fortitude to hold positions long enough to be proved right. In addition to being able to quantify value and pursue it when it's priced right, successful investors must have a sound approach to the subject of risk. They have to go well beyond the academic singular definition of risk as volatility and understand that the risk that matters most is the risk of permanent loss. They have to reject increased risk-bearing as a surefire formula for investment success and know that riskier investments entail a wider range of possible outcomes and a higher probability of loss. They have to have a sense for the loss potential that's present in each investment and be willing to bear it only when the reward is more than adequate. Most investors are simplistic, preoccupied with the chance for return. Some gain further insight and learn that it's as important to understand risk as it is return. But it's the rare investor who achieves the sophistication required to appreciate correlation, a key element in controlling the riskiness of an overall portfolio. Because of differences in correlation, individual investments of the same absolute riskiness can be combined in different ways to form portfolios with widely varying total risk levels. Most investors think diversification consists of holding many different things. Few understand that diversification is effective only if portfolio holdings can be counted on to respond differently to a given development in the environment. While aggressive investing can produce exciting results when it goes right, especially in good times, it's unlikely to generate gains as reliably as defensive investing. Thus, a low incidence and severity of loss is part of most outstanding investment records. Oaktree's motto, "If we avoid the losers, the winners will take care of themselves," has served well over the years. A diversified portfolio of investments, each of which is unlikely to produce significant loss, is a good start toward investment success. Risk control lies at the core of defensive investing. Rather than just trying to do the right thing, the defensive investor places a heavy emphasis on not doing the wrong thing. Because ensuring the ability to survive under adverse circumstances is incompatible with maximizing returns in good times, investors must decide what balance to strike between the two. The defensive investor chooses to emphasize the former. Margin for error is a critical element in defensive investing. Whereas most investments will be successful if the future unfolds as hoped, it takes margin for error to render outcomes tolerable when the future doesn't oblige. An investor can obtain margin for error by insisting on tangible, lasting value in the here and now, buying only when price is well below value. Eschewing leverage and diversifying. Emphasizing these elements can limit your gains in good times, but it will also maximize your chances of coming through intact when things don't go well. My third favorite adage is, never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. Margin for error gives you staying power and gets you through the low spots. Risk control and margin for error should be present in your portfolio at all times. But you must remember that they're hidden assets. Most years in the markets are good years, but it's only in the bad years, when the tide goes out, that the value of defense becomes evident. Thus, in the good years, defensive investors have to be content with the knowledge that their gains, although perhaps less than maximal, were achieved with risk protection in place, even though it turned out not to be needed. One of the essential requirements for investment success, and thus part of most great investors' psychological equipment, is the realization that we don't know what lies ahead in terms of the macro future. Few people, if any, know more than the consensus about what's going to happen to the economy, interest rates, and market aggregates. Thus, the investor's time is better spent trying to gain a knowledge advantage regarding the knowable industries, companies, and securities. The more micro your focus, the greater the likelihood you can learn things others don't. Many more investors assume they have knowledge of the future direction of economies and markets, and act that way, than actually do. They take aggressive actions predicated on knowing what's coming, and that rarely produces the desired results. Investing on the basis of strongly held but incorrect forecasts is a source of significant potential loss. Many investors, amateurs and professionals alike, assume the world runs on orderly processes that can be mastered and predicted. They ignore the randomness of things and the probability distribution that underlies future developments. Thus, they opt to base their actions on the one scenario they predict will unfold. This works sometimes, winning kudos for the investor, but not consistently enough to produce long-term success. In both economic forecasting and investment management, it's worth noting that there's usually someone who gets it exactly right, but it's rarely the same person twice. The most successful investors get things about right most of the time, and that's much better than the rest. An important part of getting it right consists of avoiding the pitfalls that are frequently presented by economic fluctuations, companies' travails, the market's manic swings, and other investors' gullibility. There's no surefire way to accomplish this, but awareness of these potential dangers certainly represents the best starting point for an effort to avoid being victimized by them. Neither defensive investors who limit their losses in a decline nor aggressive investors with substantial gains in a rising market have proved they possess skill. For us to conclude that investors truly add value, we have to see how they perform in environments to which their style isn't particularly well suited. Can the aggressive investor keep from giving back gains when the market turns down? Will the defensive investor participate substantially when the market rises? This kind of asymmetry is the expression of real skill. Does an investor have more winners than losers? Are the gains on the winners bigger than the losses on the losers? Are the good years more beneficial than the bad years are painful? And are the long-term results better than the investor's style alone would suggest? These things are the mark of the superior investor. Without them, returns may be the result of little more than market movement and beta. Only investors with unusual insight can regularly divine the probability distribution that governs future events and sense when the potential returns compensate for the risks that lurk in the distribution's negative left-hand tail. This simple description of the requirements for successful investing, based on understanding the range of possible gains and the risk of untoward developments, captures the elements that should receive your attention. I commend the task to you. It'll take you on a challenging, exciting, and thought-provoking journey.